Welcome to our panel on the nexus between the foreign exchange markets and the stocks and securities markets. I'm Jack Drohan with Drohan Lee LLP in New York. I'm going to let our distinguished panelists introduce themselves, starting here on my right with Kevin McPartland and continuing across, if you would. Sure.
Thanks, everybody, for being here. So I'm Kevin McPartland. I am the head of market structure and technology research for Greenwich Associates. Greenwich Associates is a research-based consulting firm, so we spend a lot of time talking to institutional investors about what they trade, how much it costs them, how they pick their brokers, and on, and then examine that data to try to understand sort of where the market's going and sort of what that all means.
Okay, my name is Bill Goodbody. I'm the managing director and business manager for KCG Hotspot, or Hotspot FX. You know, that's the institutional FX ECN owned and operated by KCG Holdings, with the marriage of GetGo and Knight Capital Group from a year ago, for those not familiar with it.
Hi, I'm Jamil Nazarali. I'm head of Citadel Execution Services. Citadel Securities is a leading market maker in most securities that trade electronically.
Hi, I'm Bob Savage. I'm the CEO of a new macro systematic hedge fund, CCTrack Solutions, and we're involved in most liquid markets.
I'm James Sinclair. I'm the CEO of MarketFactory. We're a technology company that provides access, limit monitoring, and so forth to all the markets worldwide for institutional FX. My own background is that I was with EBS right from the very beginning, and before that I was at Citibank for actually about 10 years.
That's right. Well, I discussed this topic with the panelists prior, and we've all agreed it's a fairly broad topic in certain respects. I think that looking at what the nexus is between the equity markets and the foreign exchange markets, one lesson that I suspect a lot of our participants are interested in is the fact that structurally the equity markets, especially electronic markets, have had at least a 9 to 10 year head start over where foreign exchange is currently, retail FX especially. And you can even broaden it back further than that if you go to Instinet being the first securities ECN in 1969. I was privileged to be involved in the creation of the first Forex ECN, Matchbook XS, in 1999, which was derived from the NextTrade ProNet product. So I guess I'll start my questions with Jamil. You know, where do you see the structural development of electronic markets in Forex growing from here? What lessons have we learned from the equity side? And you know, we think with special, I think we're all specifically interested in non-bank liquidity issues.
Yeah, I see non-bank liquidity growing pretty dramatically over the next few years. You know, I think one of the trends that's going on that happened in equities about 10, 15 years ago is that 10, 15 years ago, most retail firms internalized the other side of their clients' trades, which currently happens a lot in FX. I think a combination of decimalization, which put pressure on spreads, as well as more regulatory oversight around best execution, resulted in virtually all of the retail broker-dealers getting out of that market-making business. So I see that as one trend that's going to happen. And it's going to be a combination of banks and non-banks that become the market makers and provide that liquidity. I think the other real key difference between the equities markets and the FX market is the notion of the consolidated tape and one central market. That's going to be a real hard one. I don't see that changing because of the bilateral credit, and you don't have a central market, and you don't have one market where everyone can trade on yet, short of some regulatory change. I don't see that as something that's going to change anytime soon.
That's an interesting point. Bob?
I think that there's a couple of things that are very different about the equity electronification, if there is such a word, that happened and the foreign exchange one. 60 to 70% of foreign exchange is already electronic. Has been electronic since really the EBS days. And the transparency of the market has been there in a much more dramatic way than even in a quasi-electronic equities market. So it's not about spread. The price discovery mechanism in foreign exchange is very different because it's not on an exchange. It's not settled on an exchange. And as the last panel highlighted, foreign exchange is completely dependent upon credit. Vis-a-vis anyone that's a non-bank has to have a facade of a prime broker to settle their trades. This gets to the heart and soul of the real problem in the foreign exchange market, which is there's a big divide between G10 foreign exchange and the rest of the world. And so capital rules and the movement of capital into emerging markets is very different than it is between Europe and the United States or Europe and Japan. And that isn't going to change very quickly at all. Right. And that gets to the other part of what I think, if you look at the title of this panel, we're supposed to talk about lessons from equities and other securities into the foreign exchange market. Well, there are codependencies, and not necessarily a good codependency, as you know, everything in the psychological literature would suggest. The role of equity flow in emerging markets with some countries is welcomed. Take India, for example. They're happy to have foreigners come into the market and go out of it. But if you want to buy an Indian bond, we want to slap all sorts of controls on it. Flip that around, in Poland, they want you to buy their bonds. And perversely, these differences end up changing the players, and their access to these markets becomes a derivative of the asset flows that they can trade. And so foreign exchange becoming more electronic than the 60 or 70% is going to be dependent a lot on the globalization push for open markets, which in my mind has stalled.
I see.
And I can throw.
Kevin, please, yeah.
I can throw some numbers in there, and we talk about the differences. So, especially with the help Michael Lewis has given over the last couple of months, right? There's sort of this perception that equities is all electronic, right? And so we look at institutional investors, so hedge funds and pensions and asset managers and such. We still show in the U.S. about 55% or so of equity flow still goes through a sales trader over the phone, right? So yes, that sales trader at the big bank probably then puts it into an algorithm, but the client interaction with the market is through a person. The FX side, to your point, in our numbers, like I said, we're focused just on institutional investors. It's almost closer to 80%. So in a lot of ways, the FX market is much more electronic than the equities market from a client's perspective. I guess the flip side, and we could talk about maybe why this is, because I'm not sure I have the answer to why. Algo usage in equities is maybe 30-35%, whereas in FX it's high single digits. Right? That seems to be growing really, really fast, and it comes back to some of the points made in the earlier panel about there being less traders on the desk because of some of the scandals. People are afraid, the traders on the sell side are afraid to tell their clients anything because nobody wants to do anything that's going to get them in trouble anymore. So sort of that information flow has slowed down, which is discouraging clients from picking up the phone because that's really why they would pick up the phone before, which could lead to more sort of e-trading and algo usage. But yeah, I mean, the markets are fundamentally different. You talk about G10, I think that's the other thing. And when we talk about FX, it's largely, most of the market is like 10 things. US equities alone is what, 4,000 or 5,000 issues. So in that regard, they're also very different markets. It's like you're trading cash, which we all understand, right? It's just money versus, stock, which is a little bit more complicated.
One of the things that drove the movement towards electronic trading in equities was that historically banks had provided the block liquidity, and over time, because of capital requirements and losses and cost pressures, they provided a lot less block liquidity. And so instead of housing that liquidity, they were just taking that block and trading out of it. So they weren't providing that value-added service. They weren't renting out their balance sheet. That same thing may start to happen more and more in FX, particularly with what you're seeing now with the banks slimming down the number of FX traders they have, pressures on balance sheet and committing capital, resulting in them, trading less,
I have to say that I
buying
think
out liquidity.
Yeah, I have to say I think the bank's positions in FX are very well established and very secure in many ways, because one of the big differences between FX and other asset classes is that there's this huge community out there. They don't really want to trade foreign exchange. They're trying to do something else. They're trying to buy equities. They're not foreign exchange funds. And they want to behave as customers, and will do for some considerable time. The primary relationship is between them and their bank. And that extends to corporates, even us as a corporate dealing with our banks, to institutional investors and so forth. FX isn't what they want to do. They want to behave as a customer. They do not want to trade. They don't really want to use algos. And by the way, on that point, the other difference is, whereas the growth in algos, et cetera, in equities has been very sharp, in FX, I keep asking myself, why hasn't it grown like it has in equities? And I think the reason is because the risk transference model in FX between a customer and its bank is so good. I mean, quite honestly, if you're a big fund and you want to execute a large amount, and your bank will do it for half a pip of slippage, do you really want to spend all that time working the order? Do you want to buy 10 at the figure and sell 5 and work it? Do you want to run an algorithm? No, the risk transference model. So the fact that there are so many people out there who want to be customers, they don't want to deal with anything except their bank, plus they don't want to trade.
I think that gets back to one of the topics that we were talking about before this panel started, which was the fix. The demand for the fix in foreign exchange and algos are very much intertwined, which is the burden on a buy-side player is to provide best execution as a fiduciary. And defining best execution in an equity space is very, very transparent. I know exactly how much volume at exactly how much price, and I can come up with a volume-adjusted weighted price for the day, for an hour, for whatever period of time I choose. And in foreign exchange, you have absolutely no chance of proving that, zero. The best you can do is say, I've gone to 3 ECNs, and I took the average price of those ECNs, the high-low over the period. And so you get this time-weighted adjusted price. So algos have a benchmarking problem.
Right.
And how do you know if the benchmark is good or not? You're taking the trust factor on that bank. I also think that algos become sinister in the sense of, well, how do I know that you're going to the right pools of liquidity? And that ties into the previous panel, which is we used to think that EBS was the center of the entire market for banks. And as we've discovered over the last, if you ask people what the biggest surprise in the foreign exchange market is in the last 10 years, it's that you had all of these ECNs being created, 20, and then there were 40, and now there are far more than 40, and everyone has been expecting every year since 2008 that we were going to have the great consolidation into the one massive structure where that's just not going to happen.
Well, what is your view about, there are a number of technologies out there that are purporting or trying to solve the price discovery problem with Forex by creating the benchmarks, creating a pseudo benchmark, creating an index linked to liquidity. I mean, the last percentage I heard, I think, was around almost 30% or more of global Forex volume was coming from retail electronic, like ECNs. Will there be a technological, solution? Keeping in mind, if we create a benchmark that's accepted, Europe recently is making initiatives to criminalize manipulation of the benchmarks. We're in an environment where Dodd-Frank requires a mid-market rate report. We've had MiFID in Europe requiring the best execution for years now. Alternatively, if as the non-deliverable forwards and a lot of the currency options are now being driven to clearing, if spot and forwards are driven to clearing, will there be a regulatory solution? And I guess my question is, would either of those be something that you would view that would work. I'd like to ask Bill, if I could, what his opinion is on that, and then I'll switch it over to Bob.
Yeah, I mean, I think the benchmarking question and the fix issue, I mean, the previous panel sort of touched on a little bit. One is trying to get all the various assets and contracts out there that are currently tied to the fix as it exists today to change. I mean, that's just a massive undertaking. That's going to take a lot of blood, sweat, and tears to get done. And some people don't really have a real interest in changing it, so hopefully they'll change the mechanism, not have to rewrite all these contracts and deal with that. I mean, the other issue, though, I think around benchmarking, though, is that's the one time a day close, if you will, for the FX market to value all these assets. The more challenging aspect that Bob certainly mentioned, though, is the real time things that free up algos to really perform well, TCA and all those kind of products. I mean, there's lots of people I think who try to do that and try to prevent create a snapshot of the market that and do some TCA around that. But the problem that you have because of the fragmentation. I mean, it's a completely fragmented market, more so than any other probably. And everybody's view of the market is different. It's fundamentally different just based on credit alone, but then it's different based on whatever their drivers are. They may plug into one bank, they plug into 10 banks, they plug into 5 ECNs, a couple of banks, they may use aggregation technology, they may do it themselves. Everybody's approach is different, and I don't think you're going to get a third-party solution to come up with a universally accepted, hey, this is what the midpoint in institutional FX is right now. I just don't see that happen. And that's an obstacle to really, I think, to algo adoption to a degree. Plus, it's difficult to manage that fragmentation and navigate, as well as things like TCA to really take hold, because it's always going to be some bespoke solution, much more customized than it is like in equities, where it's easy. Here's the NBBO, here's the midpoint, here's the VWAP. Everyone agrees to that.
Yeah, I think that it's going to be very. I mean, firstly on benchmarks, I personally don't understand. I'll say it because I'm not a banker these days, but I can't understand how a trader can live in this environment and fix off that benchmark. I mean, realistically, you've got these huge orders minutes before the benchmark. You have to pre-hedge, and you have to do that. And you've got all sorts of conflicts between you as representing the bank and you as serving your customer. So I don't really understand. I think they're in an impossible position. The only answer is surely to have multiple benchmarks. The difficulty for that is that there's one particular benchmark which is written in a lot of documentation, etc. But you can't. This industry survived from 1971 right through almost 2000 without benchmarks. We did survive. But there were some benchmarks, like I remember when I was in Japan, I lived in Japan for 12 years, there was a closing price, which people often benchmarked off the Japan. It still exists. Mm-hmm. But the key point is London was open. Whatever was benchmarked against it was a tiny portion of the liquidity. What we're doing now today is benchmarking off at a point in time where the volume that's trying to get benchmarked is an enormous multiple of what the underlying volume would be otherwise at that price, at that time.
I mean, I think you're raising a very important point about benchmarks and liquidity are really a heart and soul of the issue. At any given point, you know exactly what the price is, but you have no clue about the depth of that price. So getting the depth of the price in a nanosecond or a millisecond or microsecond is really the problem of benchmarking. But transport this problem 2 years from now, 5 years from now. What's going on in the foreign exchange market is a shift in liquidity. And we're seeing that shift go from Europe to Asia. If you want to be involved in the foreign exchange market in the next 10 years, and you do not face Asia, and you're not focused in Asia, you're missing the entire point. And that I would predict that Japan benchmark will become far more important, as will fixings throughout the Asian center banks. Now the other issue is a far more complicated one, which is that between shadow banks and banks, and the role of regulation, as the other panel discussed, was when you have a contract that is transparent and the value is known, it becomes securitized. And the credit issue becomes less worrisome. So the push to CEFs over time will make the shadow banking industry less scary to regulators and potentially maybe less prone to a credit crisis that surely will follow. I mean, we know with certainty certain things. Foreign exchange will always come back in volatility and volume, and that there will be another credit crisis. So that the next credit crisis will be revolving around the difference between banks and shadow banks, and it'll probably be in the least regulated places.
And I think from that, I want to pick up on the regulatory point, which actually eventually will lead us back to Asia. So if we think about the US, it's really just NDFs and options for trading and clearing. So when we talk about CEFs, that's really, and there's nuance too, we'll get to it, but that's really the main drivers. Options, they still don't know how to clear them because of the settlement issue, so that's not going to happen. We're years off. So NDFs is the next logical step. The CFTC, we talked to them a couple of weeks ago. They're looking at it. The rules are drafted, but they're tabling it. They've got bigger fish to fry, so we'll see, maybe by the end of the year. So let's say they mandate NDFs for clearing, and then a couple months behind that would be trading on CEFs. We're going to go from an NDF market where people post almost no initial margin to a market where people have to post 5-6% initial margin, right? Completely changes the economics of the product, right? So if you want to trade an NDF, you then have two options. You trade futures, right? Because they're not too far off. They're like IMM dated NDFs, to oversimplify, or you go to Asia, right? So there are other regulations that will hit forwards and swaps, right? We have uncleared margin requirements. Basel is going to certainly have an impact there as well. But it leaves me wondering if any of the FX market will truly fall under sort of the broader clearing and CEF bit of Dodd-Frank. Now, there's sort of the footnote 88, which some may be familiar with, right? That makes guys like you have to register as a CEF, even though you're not trading mandatory products, which I'm sure has been a bit of a nightmare. But in terms of mandatory trading of FX on CEFs, I'm somewhat skeptical how successful that will be over time, and if the CFTC will, and SEC for that matter, will get sidetracked by other things, and in realizing that it's not really terribly sensible for FX given a number of factors.
The most pressing immediate issue that would help in the regulation, by the way, to I think people who trade in this room, is probably the ability to clear up the issue of Tomnex rolls, and are they a non-deliverable forward? Because right now, the prime brokerage options that people have are quite limited because you have to have somebody who's a registered swap dealer, in effect. If you're going to have an overnight position, you can't use a foreign prime broker because they can't roll overnight because there's lack of clarity as to whether a Tomnex roll, which never gets delivered, is a forward or a non-deliverable forward. So that's, do you know when that would be cleared up?
Well, that's actually a very interesting point, and there's even a further risk, as a lot of people here have heard. There's this rolling spot question that the Commission is still not really giving clarity on. And what terrifies a lot of market participants is that the Geithner letter, which was the exemptive letter for deliverable spot forwards, which clearly excluded non-deliverable forwards, it excluded the options. The Commission has taken a public position that they're going to construe it narrowly, and the deliverability, aspect, they may well take the position that any unnetted positions that are not actually intended to be delivered are in fact swaps, whether they're spot forwards or deliverable forwards. Now I agree with everything that you said, Kevin. I think we're still way short of even clearing, like the options and non-deliverable forwards, and I think it could be a significant market shock to the bank business, even if we force the NDFs to clearing. But, I think this ties in with where the Commission itself is going and its historical approach toward regulation, which it was price discovery based. And I'd like to just get the question back maybe to Jamil again, looking at this. We've highlighted a lot of the disparities between the historical development of the equity electronic trading and what we've got with foreign exchange currently, based mainly on price discovery. But looking back at '95, when the alternative trading system became a registrable exchange, literally, there was also a non-registrable form of it, an internal exchange. What can we expect to see? Can we expect to see a similar provided this price discovery issue is solved, can we expect to see a similar internalization trend among large equity and forex players like we saw at 95 through 2000?
Sorry, internalization, what?
Well, I mean, there was a number of these ECNs that were brought inside larger funds and internal matching. And then there was the regulated ATS that allowed broker-dealers, external broker-dealers to have access, and ultimately their retail clients, to sort of have access. What analogies do you see to the swap execution facility model that we have now? And are there any lessons that we can learn in foreign exchange as to where this might be heading?
Well, I think in foreign exchange, until you solve that issue of the central tape, the central price, that's going to address a lot of things like the benchmarking. I think that until you do that, the equity market, in many cases, the development of that market, the evolution, isn't really transferable. And I think a lot of what it went through fundamentally just doesn't apply on the FX side. I think some of the things do, because they were driven by other factors, but probably the biggest change in the equity markets happened after Reg NMS, and that was a trade-through rule. Before that, you had people trading on the New York Stock Exchange at prices that were inferior to other exchanges, right? Similar to what happens in FX now, where you have multiple venues and people are trading, and there could be a better price on another venue. Until you had that trade-through, that forced the linkages of the various markets, and that drove much more competition around prices, that narrowed spreads. And I think that a similar thing would likely happen in the FX if you had some kind of regulatory change like that. But I just don't know if that's something that's going to happen anytime soon.
My answer would be a bit different to that, because I think that internalization that you refer to, where it came in with Reg ATS in equities, has happened in FX already. The reality is you do not need to get a regulatory license to internalize in FX, so the banks do it. So whereas in equities, the major broker-dealers do have associated ATSs with them, which are clearly distinct and distinguishable, so you can see how much is their internalized flow versus flow that their otherwise non-internalized flow, their agency business. But in FX, you don't have to do that. So when you get a bank API, when you get a bank feed, in reality, that is an internalization engine. The reality is, these days, there's very little difference from a customer's perspective to getting. There are differences, but there are fewer differences getting it from an ECN, a non-bank market maker, a bank market maker with a big internalized flow behind it. Sure. Internalization is a major objective for banks, as we all know, for a long time, because it has huge advantages. You avoid crossing the spread. You don't pay any bro. Right. And yeah.
Okay.
I think one key difference, though, is that in the equities markets, when that internalization happens, there's much more transparency with the price that you got in that internalization relative to the market price, and there's much more focus on the measurement. So you probably have not dissimilar amounts of internalization, but what we saw when starting about 2000 with Rule 605, when the SEC had brokers disclose their execution quality, was a steady downward march in the price of internalization relative to the market. So it used to be the case, probably around 2000, that if you looked at the average execution price relative to the NBBO, it was higher, right? And that makes sense because a lot of times the trade sizes are larger. But now, retail, as an example, actually gets a much better price on average than the national best bidder offer. And that was driven by having that benchmark, and you compare the internalization. But right now, when a customer is calling their bank and getting that bank feed and getting that internalized price, they really don't know if it's better than they could have got, and that makes it hard to put pressure on getting a little bit better.
That's right. Great. So I've been told now that we need to get the floor open for a few questions. We're getting a little short on time. This has gone a lot quicker than I expected, which I think speaks for how intriguing it's been. maybe with a view toward more general questions or specific questions about liquidity, good liquidity, bad liquidity. Does the floor have any questions they'd like to ask the panel? And if not, I'll supply them myself, so warning. Yes, okay.
Yeah, I would reserve judgment on whether Reg NMS was actually good or bad, and I missed the beginning, so maybe this was addressed. But I'd be curious to know what you thought about a centralized tape for FX, whether just simply having the trades reported to a central point would be beneficial or not beneficial to the industry.
I think it would be very beneficial to the industry. I don't think it would be beneficial necessarily to many of the liquidity providers out there, because I think it would facilitate the price discovery process. It would facilitate comparing the prices that you got relative to, you know, the central, the market, and that would make it a much more competitive market. So I think this would be good for real traders of FX. I think that over time it would probably be bad for people to provide liquidity unless you're really good at providing liquidity. And I think some of the non-banks would do really well under that.
I just, very briefly, I think that it would be probably good for end users in theory, certainly in large, deeply traded currency pairs. But there are plenty of examples in this world of where you have a tape come in and you find that liquidity dries up in less liquid things. And then the classic example in the United States is the corporate bond market, where when Trace came in, that really affected the corporate bond market. It did, admittedly, there was somewhere else it could go. It went to CDS, to credit default swaps. And we saw what happened there as a result. But
I think your point here, and I think it's a valid one, is transparency does not beget liquidity. And the heart and soul of the foreign exchange market is still the credit problem. In equities, it doesn't matter that you're settling a security. In foreign exchange, the price that you get is determined by your reputation with the banks and your ability to have credit with a larger pool. So who your prime broker is and that prime broker's willingness to extend you credit to a larger pool of aggregators is determining how that tape would look. So just because somebody prints a price, and again, I can't imagine this tape flashing and being radioactive in something like the Euro at 8 o'clock in the morning in New York. It's kind of a meaningless set because it's not applicable to probably 50% of the players in the market.
So I agree that it's not always meaningful, but I think that transparency is good. I think I disagree with you that Trace...
I disagree completely that transparency, this is not, the whole idea about transparency is a regulatory one that it's like an antiseptic. If you have a wound and you open it up to the sunlight, it's going to heal faster. I don't agree with that in markets.
But we're talking about post-trade transparency. We're not talking about pre-trade. We're talking about this is what the price of the trade went off. And what you saw in the bond markets with Trace is that people were screaming at their banks because they were getting prices that were way off market. They were getting ripped off and they didn't know it until the prices printed to the tape.
And
I think we have time. Do we have time for one more question? Okay, let's get just another question.
You know, just coming from retail space, there's massive fraud in the FX market compared to equities. There's no transparency whatsoever. And I think almost any customer will tell you this as a point of fact, not even a point of opinion. So my question is, we're talking about NDFs, we're talking about EM currencies, all sorts of complex securities. Why not make a consolidated tape for just G10, which is 90% of what retail flow is, that would create a much more transparent market for 90% of the participants on the retail side? Why not enable just that one simple solution in order to make the market much more attractive to a lot of participants?
Well,
Short
I like to
answer.
sort of start on that. I mean, I think, again, one is that I don't think you don't have the regulatory push to make that happen. Right?
But wouldn't that be a good idea?
I have no issue with the idea of a consolidated, but I do think it would create some change or just more transparency in data. I mean, just look at across the FX product. People think it's sort of transparent, but getting data from venues is extremely difficult. Usually you're waiting at least a month, maybe a quarter, maybe every 3 years to get a good picture as to what the heck happened in this market. It's unlike anything else. And even though you get a CLS number, it's hard to figure out, well, what the heck does that number mean? How does that tie to data that's reported? Publishing data out of venues, even among the 10 or so venues that are out there trading any decent amount of volume, 3 of them report volume. They don't even report it in a consistent manner. I think you'll hopefully see a trend towards that. We recently started publishing daily volumes for Hotspot. We're the only over-the-counter venue that's doing it. The feedback from clients is immediately people want the data. There's no doubt. They're like, they want more. They want currency level. They want hour data. They want everything. So I mean, the demand's there. I think if you get, if the consumers of the product are out there pushing for it, you'll get more people creating that, and then maybe you get some third party to aggregate it. I don't think there's going to be a regulatory push to make it happen.
I think there has to be a regulatory push, but
That might be the only way to do it.
Yeah,
because it's so big.
the other angle would be, could the tail wag the dog? In the derivatives market, one thing that does hit FX is reporting, right? So all those derivatives trades are now getting reported, and the data is getting there. But if we start to get some transparency into the price of forwards and options and swaps and NDFs, and people start to do that analysis, I'm sure there's a lot of smart guys at Citadel that are trying to figure that out, right? Maybe that's going to help in sort of forcing some more transparency into the spot market where there wasn't any before.
Well, I'd be
Gentlemen,
careful
I
what you...
hate to be the bearer of bad news and to end this exciting chat, but I think we are completely out of time. And I want to thank Shift Forex and all of our sponsors, many of which up here I'm glad to see are also securities traders as well as FX. And thank you very much, and let's have a big hand.